Anyone going into business has to consider this. Which business structure is right for you? You've got sole traders, partnerships, companies, trusts. It can be a minefield if you're not across the differences between all of these. In this video, we're going to take a look at some of the common structures and what are the pros and cons associated with each. First of all, guys, I want to stress that this is a guide only. There are many different factors and many different variables that you must consider before deciding which business structure is best for you. Some of these factors, just to name a few, include asset protection, taxation, the utilization of losses, legal liability, succession planning, and the cost and the complexity of running these structures. Now, everyone has a different situation. Every business is different. Every individual is different. It's really important not to take this as strict advice because there are real consequences to getting it wrong. I do encourage you to seek further advice. We can help with that if you wish. I'll leave a link in the description. Otherwise, go speak to your accountant or your lawyer. The purpose of this video is just to give you an introduction into what options are on offer. Now, the first option we'll look at is the sole trader. Now, the sole trader is a very easy way to get started in business. There is very little cost or no cost to setting it up if you do it yourself. It is relatively straightforward in going in and setting it up with the Australian Business Register. And it is relatively straightforward to do your tax if you're comfortable doing that, in that you don't need to use a tax agent because it runs through your personal tax return along with any other job income. And because it runs through your personal tax, that means you are taxed at the same marginal rates that you would be taxed on your job income or your investment income. It all gets thrown into the same bucket and then you are taxed on that as you would be with any other income that you make. The biggest drawback with the sole trader is that because you are the same legal liability, that means there is no firewall or no legal distinction between you as an individual and your business. It is all one and the same thing. Because you are that same legal liability, it means you are legally liable in that if your business happened to get sued or if your business took out a loan that it couldn't repay, then you would be personally liable for that. That means if your business happened to get sued because you put out a product that happened to be faulty and someone was injured, whatever it may be, if someone brought legal action against you and they succeeded, that means not only can they go after the business assets, they can also go after your personal assets. So that means the family home is at risk. Another thing with a sole trader is, even though it is a good little way to get started, it's low cost, it's easy to get going, the thing with that is people will know that you're basically a small business, you're a small fry, if you want to put it that way. If you're starting out a business and you want to put out an image that you are maybe bigger than you are, or you want to put forward a kind of image that you are successful, you're not just some guy working out of his bedroom getting started, well then the sole trader can give that away. Because as soon as anyone has a look at your ABN on the ABN register, they'll see straight away that it's you as an individual, you're not a company, and basically they'll know straight away that this is a small operation. That can be a good thing as well, but maybe you don't want to come across as a small operation. Next up is a partnership. A partnership is very similar to a sole trader, except the only real difference is that you have two or more partners involved in the business. So this means that it is the same legal entity, much like a sole trader. The partnership, if it's two people, they make a profit. The profit gets split in two if that is your partnership agreement, and then that half of the profit flows through to your individual tax return. That's how it works. The other big thing with partnerships is that you are said to be jointly and severally liable. That means if something happens in the business and one of your partners can't afford to pay for this mistake that is costing the business money, then the other partner could be liable for that. They are jointly liable and they are severally liable. So that can be a risk. So you want to have a solid partnership agreement in place that states if things do go awry, who exactly is responsible for what and where does your responsibility end. And just so you have a good understanding between the partners of how the business is going to run, how maybe new partners are going to come in, how are you going to exit the partnership if one person wants to leave, and all that kind of thing. And just where I said that when you split the profit and it flows through into the two individual tax returns, that profit from the business will then be taxed at the same marginal rates as those individual tax rates. Now let's look at companies. Companies are probably the best known structure and the most common structure for carrying out a business. Now, there are basically two types of companies, two main types of companies, and that's your public company and your private company. A public company is a company that is registered or that trades on a stock market like the ASX or the NASDAQ. It has publicly traded shares, it's a public company, anyone can buy into it. A private company is privately held. You can't buy into that unless you have an opportunity to buy into that. It is like a family company, or it might have a group of shareholders, but it's not traded on the open stock market. In Australia, a private company is known as a PTY Ltd, Proprietary Limited, that stands for. A public company is just Ltd or Limited. So whenever you see PTY Ltd, you know it's a private company. Whenever you see Ltd on its own, you know it's a public company. In the US, you've got LLCs and S-Corps and things like that, but the concept is very similar. The big advantage of a company is that it is a separate legal entity. That Ltd on the end of the PTY Ltd, that means that the liability is limited to the share capital that is issued on the company. So that means if a company is in business and it gets sued, or it defaults on a loan, or it's forced into bankruptcy for whatever reason, if it runs into trouble that way, that means when creditors come after the company, they only can go after the amount of share capital that is invested in the company. That means if you own a company and you had net assets in the company of say $50,000 and you went bankrupt, you could lose that $50,000, but they cannot come after the family home. That is the important distinction here. Having a company creates a firewall, it ring fences your business, the risk into your business, and it protects your personal assets. Only company assets are at risk, and your personal assets, in most cases, as long as you don't break the law, are safe. Now, the basic setup of a company is that you'll have a director. You can have a sole director, or you can have multiple directors. You can have a secretary as well. And then you have shareholders. You can have a sole shareholder, so you can be a single person company where you're the director, you're the only shareholder, or you can have multiple shareholders where the ownership of the company is split across multiple people or even multiple businesses. You can have other companies owning companies and that sort of thing. There is also more flexibility with companies in that you can pay out directors' fees, you can pay out wages, you can pay out franked and unfranked dividends. And having these different options for paying out money means that profits can be taxed within or outside of the company. So that makes a difference and just adds to your general flexibility of how you want to treat things as well. Another good thing about companies is that they pay a flat tax rate. So for most small and medium enterprises in Australia, companies will be paying 25% tax at a flat rate. If you compare that to an individual, if you're earning over $45,000, you're going to be paying at least 32.5 cents on the dollar for tax. So that is a good amount higher than the 25% that is offered to most small and medium-sized companies. And going back to what we said before about individuals and sole traders maybe coming across as a sort of like a startup, small fry kind of business. Well, at least with a company, you've got that PTY Ltd after your name. So straight away, people know that you mean business and they know that you're a serious player. And that might be something that's important to you when you're starting out. Now, there can be more reporting associated with companies. Often when you go to an accountant to do your company tax return, the common package would be to do the tax return and the financials. Along with the higher cost to do the tax return and the financials each year, you also have to register with ASIC if you're in Australia, the Australian Securities and Investments Commission, to set up the company itself, and then you have to pay a renewal fee each year. So this is an ongoing cost that you have to pay to keep the company going. One of the disadvantages that comes with a company is that you're not able to claim the capital gains tax 50% discount, as you can with many of the other entities that we'll go through. That means when you sell a capital asset, you're not claiming a 50% discount on the assessable rate, you're paying tax on the full gain amount. Although it's important to note that there are other concessions and rollovers available to companies when selling assets. These are known as the small business concessions, and they can reduce your liability to nil in some instances. So you do have some options there. Now, when you set up a company and you register with ASIC, you are signing up to be governed by the Corporations Act. That's the piece of legislation that governs companies that ASIC administers. So this means that when you sign up as a director of a company, that means that you are taking on certain responsibilities and duties that you must adhere to under the Corporations Act. So there's good reason why companies are the most common way of doing business in Australia anyway, but it's important to note as well that there is added complexity that comes with it, with your directors, shareholders, public officers, secretaries. It doesn't have to be as complex as it sounds, but there is definitely a lot more to it when comparing it to a sole trader, for instance. Now, the last structure that we're going to look at is a trust. And you've probably heard of family trusts. Well, a family trust, that's sort of what it's known as in the community, but what it really is a discretionary trust. This means that the business operating through the trust has the discretion to distribute profits to different beneficiaries of that trust. And alongside discretionary trusts, the other main options are unit trusts and hybrid trusts. But discretionary trusts or family trusts are definitely the most common form of trust in Australia. Now, trusts can be a little bit complex if you don't have a background in this sort of thing. The main roles in a trust are the settlor, they're the person that establishes the trust. Then you have the appointor, they're the person that appoints the trustee. And then you have the trustee. The trustee is the person or the entity, it's often a company, that is responsible for carrying out the day-to-day activities of the trust. And then of course you have the beneficiaries. These are the people that benefit from the trust. So the people that take the money, the earnings from the trust, get distributed down to the beneficiaries. And with the trustee, you can have either an individual trustee or a corporate trustee being a company. A corporate trustee is much more common. The only real benefit of an individual trustee is that it still allows you to operate the trust in splitting income and things like that, but a lot of the asset protection and legal liability that you gain with having a corporate trustee aren't there with an individual trustee. So in most cases, if you want the full protection of running a trust, a corporate trustee is the way to go. But of course, that means it's another company that has to be set up. It's a little bit more complexity, a little bit higher cost that goes with it. But like with a lot of these things, if you want the benefit, if you want the full protection, then you've got to stump up the cash. It's a choice that you have to make. Now, one of the big advantages that attracts people to trusts is, of course, the ability to split income. Now, the rules around this are always changing. There is a bit of action out there at the moment with the tax office in various countries looking to clamp down on some of the benefits that come with income splitting in trust, but they still are quite an attractive structure in themselves in many cases. But the premise behind income splitting is if a business that is operating in a trust, say it makes $100,000, then if you're running a discretionary trust, then the trustee, which may be a corporation which you may be the director of, can then at their discretion say where that $100,000 is going to go. So you could send money, if you've got this trust and your beneficiaries are your family members, you can direct the higher profits to family members who are adults who are on the lowest income tax rate, so in the lower marginal rate, and then direct the lowest portions of profits to family members that are in the higher marginal rate. So because you have that discretion to split the income and move it to beneficiaries that are in lower tax rate, it enables you to bring the whole tax rate down for your family unit. Now, of course, another thing that attracts people to trusts is the asset protection. Trusts are generally the highest level of asset protection that is available when compared with other basic entities. So if this business happens to get sued, the creditors will go after the corporate trustee initially. So you've got that company there, but they're not going after you as an individual. They're going after that trustee, which doesn't really hold on any assets. And then they probably will go after the trust itself, but at least they won't be able to go after you as an individual. They won't be able to go after your family assets or your personal assets. Now, trusts offer the ultimate flexibility in getting money out of the business. You can pay a wage, you can distribute money, you can split the income to reduce your tax like I was saying earlier. You can also distribute money to other companies. Trusts offer a great way to transfer wealth over generations, because say if you have a family farm and it's owned in the trust, well then when mum and dad retire, that family farm doesn't have to be sold off and maybe have capital gains tax and all that and transferred through to the kids. Because the kids will already be beneficiaries of the trust probably, then nothing really needs to change, because the trust will retain ownership under that corporate trustee structure, and then they will simply just change who the beneficiaries are. Like if mum and dad pass away or they retire, instead of money going to them, money will then be going to kids and lower generations of the family. Now, trusts cannot negatively gear losses. Say if you're like as an individual, if you own an investment property and it's making a loss and you're negatively geared and you can take that loss and apply it against other income, trusts can't do that. They basically have to quarantine that loss within the trust. All right, so I've thrown all this information at you, but all you really want to know is which one should you actually use. So now I'm going to go through some brief scenarios and I'll say which entities, which structures may be the best option in that case. And these are just some scenarios, guys, that I wanted to sort of put forward that might be of assistance. It's not a definitive guide and it's impossible to cover everything here. So just remember that. So if you're starting out on your own, you're just getting started, maybe you're a contractor or a small business, you might go with a sole trader to begin with. If you're starting out with a friend and you're just a very small player, you want to keep things simple, maybe you'll go for a partnership. If you want things to be solid from the get-go, then maybe you're going to go straight to the company. If the business is becoming more serious, maybe you might have started with a sole trader or a partnership and you then might decide to move to a company or a trust. If you have significant personal assets outside of the business, a family home that's worth a bit of cash, then you're probably going to go with a company or a trust. If you're running a high-risk business, if there is a chance that you could come into legal troubles, then you're going to go with a company or a trust. And when I'm talking trusts here, I'm talking about a trust with a corporate trustee. If you're a high-risk individual going into business, then you're probably going to want a company or a trust. If you're taking out significant commercial loans, so there is some default risk there, if you can, you'll probably want to go with a company or a trust. If there's going to be significant creditors, so if you're making big purchases from suppliers, money that if business went bad, you would have a hard time repaying, then you're going to want to go with a company or a trust. If you want to put forward the image of being more professional about your business, you're not just a small player running a side hustle out of your parents' basement. If you want to put forward a good professional image, then you're probably going to go with a company. And if your main aim is to reduce income tax, then you're going to go with a company because you get the flat tax rate, or you're going to go with a trust because you can split the income. And this is just a summary of some things that you might want to consider when you're trying to decide which business structure is right for you. The thing with this kind of thing is because every situation is different, what's right for you may be wrong for someone else and vice versa. So it's really important that you get the proper advice. But you can take this information and use it as an introduction and then use that as a foundation to go and then carry out more research. If you do choose the wrong structure for the wrong business, for the wrong individual, it can end up costing you a lot of money if things sort of went bad in your business. Get it done the right way the first time if you can. Now, if you are interested in getting some further advice on this or even help with setting up a structure, I'll leave a link below. We can help you with that. Otherwise, definitely go speak to your accountant. Definitely go speak to your lawyer. Now, apart from that, guys, thank you very much for watching the video to the end. If you have any questions, hit us up in the comments section. I'll do what I can to help with that. If you have any information you want to share about some of the business structures you've run, the successes you've had, maybe some failures that you've had, some reasons why you should have chosen one structure over another, share your story. We'd all love to hear and learn from that. But otherwise, thanks a lot for watching and good luck in your business, and we'll see you in the next one.